together. Ja, maar kun je dat mee?
Kan ik met een iPhone hier? Ja, die staat altijd uit.
It's look. Ja. Okay, yes, I can see from there. Sure, just make sure. See, I have one, but there is it. So good afternoon, everybody, and welcome to this Startup Scale-Up and Innovation event here at Bruegel. It's very timely to have this event here in Bruegel because about 1 year ago the Commission came out with its Startup and Scale-Up communication. And actually tomorrow in Tallinn there will be the 1-year anniversary and evaluation of the Scale-Up and Startup communication. So definitely very good timing for this event here. We will have a very good discussion on this, I'm sure of that, because we have an excellent panel here. I'm going to not use too much time introducing the topic because I don't want to eat up the time of the people here. I just would like to, with a few minutes, just identify, I have to point there. Yep. Oh. Yeah, just like to point out why actually this scale-up is such an important issue here, why we care about this, and also trying to identify what we should think of and trying to address this. So why do we care? Well, if you start from the big picture of Europe's innovation capacity, and particularly the corporate innovation capacity here, the EU clearly has a kind of deficit on that with respect to the US. So typically the corporate R&D is in the US much more active than in Europe here. So that's what you see in the first row here. So these are all data based on the R&D scoreboard that the European Commission traces. And that overall R&D, corporate R&D business deficit is very hard for Europe to address. And this is partly because of its lack of young companies and young companies in innovation-based growth sectors. That's what you also clearly see if you look at these scoreboards firms of the largest R&D spenders. The share of young companies, and young here means just born after 75, so some of them are still already pretty old. You see that the US has way more of these young companies among its leading innovators. And if you take a look at just the top 10% of the R&D spenders, so really at the top, the difference is even more striking here, where the US has really among its top R&D leaders, more young companies than Europe has. And that matters because these young companies also are much more actively using R&D as a competitive tool here. So their R&D intensity is typically way higher than for older companies. But you see that in the US, these young companies on top of that are actually even more R&D intensive than our EU ones. And that has to do also with the type of sectors where the European companies are actually, young companies are actually involved in. If we look at innovation-based growth sectors, and those are really the sectors where there is a lot of investment in R&D needed and where there is also a lot of dynamics, technological change going on. So these are typically the digital sectors and the biotech, pharma. So these are the major innovation-based growth sectors. Again, the US is way more specializing in these sectors, where there's lots of opportunity for innovation to drive the growth of companies here. And also the US has way more of these young companies in these young innovation-based growth sectors here. And once you account for that here, there is a lot of explanation of why Europe has actually this problem of addressing its corporate investment deficit here. So this is why we care. We need to have more of these young companies that can really make it into leading innovation leaders in these innovation-based growth sectors here if we want to address our overall corporate R&D deficit here. So definitely we should care about getting these scale-up companies here in the right type of sectors. Then, of course, the question is what to do. And as usual, it's not easy what to do because it requires quite a lot of deficits to address at the same time here. So a lot of barriers are faced by these companies to turn into world-leading innovators. That's access to lead customers, that's access to the science base that goes into it, access to skills here, but also access to finance, and then particularly early risk financing here. And of course, access to external finance receives a lot of attention in this scaling up discussion here, but it's just one of the many impediments that these companies actually face in Europe here. And if we talk about access to external finance, there's lots of discussion on venture capital as a mechanism for addressing this access to finance for these scale-up companies here. But again, that's only part of the overall picture here. So that's basically the questions that the panel will be addressing here. How critical is that access to risk financing here? How specific is that for Europe? What other barriers they actually might be facing here? And then particularly, of course, also what role there is for government, any government intervention for supporting the scale-up, and then particularly what role for the EU, with what specific instruments. Is there any role for the EU in trying to support that scaling up process here? So big questions, and in about an hour we will know all the answers to these questions here. So I'd like to really start now with the panel, because we have wonderful panel members here. I'm going to start first with, okay, now I have to find my... Okay, here. So we're going to first start with Johan Cardoen. Johan Cardoen is a Belgian-Flemish scientist here. He's for the moment managing director of the Flemish Institute for Biotechnology, which is an institute which was founded by the Flemish government to actually link the science, the top science in biotechnology, also to commercial applications here. So he's definitely also in this position very much involved in bringing new breakthrough ideas to commercial value here. But Johan also has a very interesting history of working for startups themselves in biotech. So Crop Design and Plant Genetic Systems are one of the most famous startups in Flanders here. Crop Design is a very interesting example also, where initially was funded with venture capital, but then actually was taken over by a large incumbent, BASF here, and also the future developments within that larger entity was definitely also an interesting story that Johan can also talk about. So I'm going to give the floor to Johan first, and then I will be introducing the other members along here. So Johan.
Yeah. Maybe if I can just... Thank you very much. Thank you for the kind introduction. What I've prepared more general thoughts about some of the limitations we face in the life science and biotech industry in Europe, in basically bringing many of the very exciting young companies to the next level. I think I would like to give a very short introduction to give you a speed education on how does the biotech, what are the specifics about biotech companies. But before I do that, maybe a few words, because Renilde mentioned to my experience at Crop Design. So I was the CEO of Crop Design, and typically a venture capital finance biotech company. We had 3 capital private placements. We raised 42 million euros from venture capital. Very international consortium, consisting of Belgian, French, Dutch, Swiss venture capitalists in Europe. I would say a typical consortium. And we had ambitious plans. We were planning to bring the company to the stock market. We were going to, we started the whole process at the end of 2005, December 2005. We had a banking consortium, and we were planning to go listed on Euronext in 2006, last week of June 2006. And literally, through this IPO, we were planning to raise the necessary funds to basically finance the company to the next level and in our path towards a more sustainable company. And literally in quite well prepared in this process, our shareholders were approached by a company was interested to acquire Crop Design. And then a strategic decision was made by the board to say, well, we will investigate in parallel to the IPO, we will investigate a dual track. So we started a dual track. We had a restricted auction. We had 3 companies in this process. And there were 2 requirements to do that. First of all, it had to be very fast, because we did not want that an IPO was perceived as a failed acquisition. And it had to be in a very, very confidential way, which is also a challenge if you work in a very dynamic ecosystem, what we have here, because everyone knows everyone. So we run this process with different bankers and so forth. And we did this process in 10 weeks. And eventually, as Renilde mentioned, Crop Design was acquired by BASF. Now the question is, would this have been a good thing, purely looking at the future and potential of the company? And why did the investors prefer an IPO, a trade sale versus an IPO? And I think this is very obvious. First of all, venture capitalists, I would say biotech life science is very dependent on venture capital because of its high risk profile. And typically the funds have a limited lifetime, typically 10 years, maximum 12 years, before they need to return their returns to their investors. So this creates pressure. And so we had some of the funds already pushing and looking for a trade sale. A second argument is that typically if you have 3 financing rounds, there are different types of shares which are being created, some of which have preferential rights attached to it. If you bring a company to the stock market, there is only one type of shares which you can trade. So they lose quite a bit of the preferential rights. So typically venture capital will always favor, in view of that, always favor a trade sale versus an IPO. And a third reason, if you bring a biotech company to the stock market, typically there is a lockup period, 12 to 18 months, before the main shareholders or the main investors can sell their stock. And that's a risk, because today you may list at 10 euros and you never know what the stock is going to perform within a year from today. Could be higher, could be lower. So these are 3 main reasons which typically in biotech and life sciences, I would say in general, would always typical VCs favor to have a trade sale over an IPO. I would say typically, okay? But here, if you look at the first slide, you see a typical financing life cycle of a biotech company, and don't get too focused on the slide itself. There are two messages which I would like to give. First of all, it's long-term. It's a long timeline for a company to move from startup towards a cash flow positive situation. Typically, if you're talking about the therapeutics, a company who is into drug development, you are speaking about at least 12, 15 years before a company or even more is cash flow positive. So this means that that's quite a long period you need to finance to bridge this gap before this company has reached the position of sustainability. And secondly, you need a lot of money. So it's high risk, long term, and it's high capital intensive. You need tens of millions of euro to finance this period and this gap. And this is typically, I would say, a feature of all biotech and of the life science industry. And here it is more depicted if you look at the value creation process of a drug development program. And typically you start with discovery, and then after a while you go into clinical trials, phase 1, phase 2, phase 3, where you test your candidate drug into an increasing population of patients. You see that most biotech companies are facing a problem in raising the necessary funds to take their innovations beyond phase 2. So phase 2 is the phase where you test your drug or candidate drug in patient population. Beyond, if you have positive results, that is seen by the, I would say, typical financial community as a major value inflection point for the company. But then to bring this to phase 3, where you test it in larger patient populations and eventually take it to the regulatory FDA and bring it to the market, that's still a phase where major funds are being required for a company to make this step. And what you see there is that most companies who are at least listed on the stock market, they either, in order to find the funds to finance this step, they either, at least in Europe, are looking at Nasdaq. Most of them do dual listing. And we have seen this in case in Belgium, but also many other, I would say, promising biotech companies in Europe are considering to have a dual listing on Nasdaq because of several reasons. I will come back to that in a minute. But also, some of them are also establishing strategic alliances with big pharma companies who basically have all the competencies and capabilities to bring a drug to the market. Okay. Typically, 4 more slides, so we'll try to keep it short. You have 2 major business models in biotech. You have what we call platform companies. These are companies which are based on a technology platform, which is typically a differentiator, but it has the advantage that from this platform you can impinge on different applications. So you can target multiple applications, multiple shots on goal. And then you have a different type which has been, I would say, more and more apparent over the past years, also in Europe, which are more asset-centric companies. So a candidate drug, that's the asset of the company, and it's much more a binary situation. But typically for platform companies is, again, it's long timelines towards value inflection point, as I mentioned before, and there are very high capital needs to de-risk the platform and to basically bring it to this value inflection point. Asset-centric, it's less capital intensive, but it's more risky because it's binary. It's high risk. You only have one asset. So there is, and that basically, if it fails, then, well, basically you have a problem. Now, if you look at in the industry, and these are data from Kempen, which is one of the merchant banks in Holland, which is specifically following biotechnology. What is listed here is the timelines from starting the company towards acquisition, M&A. And typically what you see is that in biotech therapeutics, typical age is after 8 years, that the average age that a company is being acquired by typically either another biotech company, but typically by a big pharma company. Okay. So if you now look at what is the current financing climate, and again, this is based on, as Neil has mentioned, I work for VIB, and we are quite an active creator of startup companies. I can say that the current startup financing environment is overall quite positive. We have seen a tremendous change after the financial crisis in 2008. For 3-4 years, the VC community basically was very tough, and raising capital for new startups was highly dependent on the local investors. So we have seen since 2012, 2013, that again, many funds have raised new funds, so they need to look for good projects to invest in. So many funds, but also US-based funds, we have seen an increasing interest to scout for interesting deal flow and good projects to invest in Europe. And what I mentioned is we have in Europe quite I would say biotech-friendly stock markets. We have here Euronext in Brussels, Paris, and Amsterdam. We have the Copenhagen Stock Exchange, the Swiss stock market, London Stock Exchange. Those are, I would say, biotech favorable and friendly stock markets, and have been very important for the European biotech companies to raise the necessary funds to allow them to make this, well, the next step in their development. Now, what are the challenges which we see with respect to scale-ups is, as I mentioned before, significant capital required for companies to make the step towards a cash flow positive situation. The biotech funds and the biotech companies are highly dependent on venture capital, and typical VCs are closed-end funds. So only very few are evergreen funds, meaning that they have a certain lifetime by which they need to return to their investors as well. and it's typically 10 years. And this creates this kind of dynamic which we see and push towards sometimes M&A, sometimes prematurely. As I said here, the high financing needs combined with this limited lifetime of a fund. These biotech-friendly stock markets are key for European companies to raise the necessary funds from the public to enable them to make the next step towards sustainability, if possible. What we've seen here is that the European Union especially likes typically growth equity funds, which we see are quite active in the United States. We don't have this phenomenon as such in the US. Funds which can take tickets of 50, 60, sometimes 80, 90, 100 million euros. And that's why also we see that more and more EU biotech companies are pursuing a dual listing on NASDAQ. We have at least 4 or 5 biotech companies here in Belgium who recently listed with quite some success on NASDAQ as well. So what are the opportunities? And that's my last slide. I think it would be good if we could really push for availability of growth equity in Europe, which could basically contribute to the many promising, I would say, biotech companies which we have here available to move towards becoming what I call a mid-sized biopharma. And I listed 5 companies there in the US which are today multi-billion-dollar companies which are employing thousands of people and which all started as small startups. You know, Amgen, Celgene, Gilead, Vertex, Biogen, and there are at least 10 others which I can name as well. And this is what we are lacking a bit, but that's still what the opportunity which I see here, what we have in Europe. And it would also be good, and I don't know whether governments can do anything about this, but we have seen that if we could increase liquidity on the European stock markets for listed biotech companies, I think this would also be very, very important and very positive. Because what we see here, there is a risk that we see a shift that the strategic decision center of companies who are listed on NASDAQ is being shifted towards the United States. And that's a long-term risk which I see because the financing opportunities are, we have to admit, are still much greater in the US than they are in Europe.
Okay, thank you very much. I really like also this more optimistic view here is that there are a lot of opportunities that we could exploit at the EU here. So let's hope we find a way to get there here. But you made 2 very important points. First of all is that it's really, you really need to look at the individual cases each time, the different sectors, and even within the sectors, different types of companies have different issues here. And then if you talk about access to finance, it's really not just only looking at one instrument of one stage, but it's really taking an escalator view of all the different ways of funding. So we now turn to Luis Papa Emmanuelle. He also works very closely with startup companies here. He has a lot of experience as a consultant to grant applications of startups here to help them with their proposals. He joined the EU Startup Services about 7 years ago, if I'm correct here. So he also has a very much hands-on experience in the kind of barriers and challenges, but also opportunities that these EU startup companies are actually facing here. So Louis, the floor is yours.
So, hi, I'm going to perhaps, well, first of all, thank you for inviting me. It's very exciting to be able to actually talk about the state of European, I would say, investment, but also, I would say, the overall sentiment when we have in the startup ecosystem, which many times is very grim. I think that we should have some cautionary optimism. I think I do share some optimism. I think the state of, I would say, the ecosystem is much different than it was even 2 or 3 years ago. I would perhaps start with what we do, and generally speaking, I mean, I do represent EU Startup Services, which is a consulting firm. I have joined EU Startup Services. We launched EU Startup Services about 2.5 years ago, but it was initially a spin-off from another organization that we have, which is called the European Young Innovators Forum. This is an organization that was created about 7 or 8 years ago at a time where the word startup alluded more to a series from the US, a TV series from the US than anything else. Not many people were actually talking about it, especially not in Brussels. And so when we launched this, initially it was to be able to sort of, it was a post-crisis environment, and we had to sort of push the Commission, which was already thinking about growth. And at the time we had a very sympathetic here, Nelly Cruz, who was the Commissioner for the Digital Agenda, who was very keen on youth, very keen on growth, very keen on entrepreneurship, and who essentially supported us in launching this organization during this event that we did in the Parliament, just to sort of give some institutional backing to it. Of course, we are completely independent, but our role within that was to try to sort of give a more, I would say, debate, a debate which was much more tailored to pushing the creation of a startup ecosystem. And one of the underlying motivations was to essentially try to convince the Commission to roll out some policies in view of this famous cascading effect that it would have on national governments. So within that, we did advise a lot on several key policy documents, or key documents in general, Startup Manifesto, all of these different, I would say, flagship policy debates that we had. And fast forward, a few years later, we can see that the environment has completely changed. First of all, I mean, just from a perspective of hearing about startups in general, I mean, who hasn't today a cousin, a friend, or somebody that is involved in a so-called startup? We don't call them small and medium enterprises, we call them startups. And so I think that this is a key element that we have to consider in the growth of the ecosystem in general. With it, also, I think we can see a lot of policy initiatives, but not only at the European level, primarily at the local, regional, national level, where we have tremendous, I think, support, either in terms of funding, either in terms of mentoring, either in terms of, there are many different sort of initiatives that have been designed to be able to help spur growth, and I think this is something that is notable. Within those particular, I would say, consulting or advising that we did to the Commission was the rollout of what has become one of the most flagship initiatives in public funding in the world, I would say, the SME instrument, which is essentially, I would say, the most successful startup grant initiative, which has funded now over 4,000 companies, and with it has spurred private investments within those companies, but also in peripheral industries. So I think this is something that is extremely notable and probably one of the most important policy successes of the Commission in the past years when it comes to promoting growth. And so this is basically what we have started doing, because I mean, once we have advising, once this initiative was rolled out, I mean, the Commission, in partnership with them, we started touring Europe, because I mean, we did have access, and we continue to have access to over 500,000 people, from investors to hubs to different sort of actors within that ecosystem. Not because startups are not the only ones, and they're not the only actors in there. And we quickly realized that there was an immense skills gap, even though we had advised for a significant simplification of procedures and a much more easy access to these grants. We quickly realized that the legacy of the research agenda of the European Commission framework policy through FP7, FP6 was still very notable in there. And so basically this is how we got into the market, by launching a consulting services to have them. And today we are positioned as one of the, I would say, most successful companies that focusing on that particular grant scheme. And so we are really branded through it. And for us, this is our main bread and butter today. But obviously, this is a competitive process, and so today we are more focusing on offering much more, I would say, diverse services and also servicing also the investors, because I think that they are, and this is something that we forget. I mean, the European Investment Fund has a lot of investments within individual VC firms, because this is another way for them to be able to sort of push the ecosystem. So we do have a lot of experience in these things, and I'm very keen on helping shape up the conversation later on about what can be improved. I won't make a point on that now. I think this will be the main topic of discussion later. But overall, we have to look at this from a positive viewpoint. I mean, throughout all of these initiatives that have been launched, we can see a very different ecosystem today than we could see in 2011. We have, just in 2015, and I don't know if some of you are familiar with the topic, but one of the most, I would say, famous, out there VC firms, Atomico, and Slush, which is now one of the biggest events, if we don't consider Web Summit, one of the most interesting events when it comes to the startup ecosystem. They, do a State of the European Tech report every year, which is actually a very interesting read. And the figures are clear. I mean, you can tell that the number of investments just in 2017, I think there was 2.3 billion euro invested in deep tech in Europe. If you compare that to the 1.7 billion that was invested for a period of 4 years between 11 and 14, I mean, it's a remarkable change. And you can see that, there are other actors that are looking at this, and the patrons, I would say, and I think you were correctly mentioning that for the biotech, but it's not just the biotech. I mean, the manufacturing sector is investing a tremendous amount of money into trying to innovate and to trying to make themselves relevant. I mean, this is the largest sector in Europe. I mean, we're talking about millions and millions of jobs. And so, if we're not proactive into trying to sort of, get leadership there, automation will, eat away a lot of our jobs, and we need to be proactive, but also we need to save our industries. And you can tell that today, I think two out of three, the largest corporates have already invested in a company. 1 out of 3 has acquired one. So, investments are important, but they don't necessarily come only from investors. They also come from large corporates, and I think they're a major part of the ecosystem. They have also learned to invest much better. I mean, they used to be lost. They used to have a lot of money, and they didn't know what to do with it. So it was very clumsy for a moment, but now they've developed their own innovation programs, and it's working generally quite well. So we need to look at that. I think that we need to have a positive outlook. Things are better, and obviously things will be better. We don't have the same experience in the US. We haven't been doing this for 30, 40 years like they have been doing it. And so we need to obviously learn. We also have a lot of things to fix. I mean, I think the internal market is not as it should be. It should be much more integrated. I think this is a major impediment, both for VC firms, but also for startups themselves. And I think these are one of the points that we will address. Culture is changing, but culture is a major point too. I mean, I think that people today, even friends, families, prefer to invest in rather safe sort of products rather than go on high risk innovation investments. So this is another point, but this is also changing. So there are certain things that we can improve, but overall, we have to be optimistic.
Okay, so again, on optimistic note here, I think what was also important from your discussion is so the question is really on within the startups how to scale up and what role an instrument like the SME instrument has in the whole funding escalator here as well, and how this actually improves also the next stages of financing as well. Okay, so we're going next to François Véran. François Véran will also has a very extensive experience in supporting startups and scale-ups here as a venture capitalist here. François is the founder of a new fund, which is a venture capital fund, which has really substantial investments, about 40 current participations here. So he has, again, also a lot of experience from a venture capital perspective on the EU landscape of scale-ups and startups here. So, François, we're very much looking forward to hearing your story.
Thank you. Maybe to start with a couple of figures. In 2016, there were $55 billion invested in venture capital, out of which 21 went to West Coast Californian VCs, 13 US VCs outside California, and so for the rest of the world, it's a relatively small part. Europe is 6 billion out of these 55, and France is 1.8. So, for example, France is like less than 10% of the US VCs. Asia is 13, 50% from China. If we look at value creation in the last, let's say, 18 months or 24 months, we have over $1,000 billion for the GAFA, the Google, Apple, Facebook, and Amazon. That's a lot of money. And we have about 200 billion for the cryptocurrencies. If we take the market cap and say that maybe they're a scam, but they're easily tradable today. Venture capital as a whole doesn't make a 2 times net. That means that the value creation for venture capital in the last 12, 18 months is less than 50, 60 billion dollars, if we consider that. And Europe is a very, very tiny part of that. It's not that money is not there. If you look at private equity, and venture capital is just a sub-segment of private equity, US private equity funds gathered $190 billion last year, and Europe $110. So it's not that far. So what's the problem and where's the funding gap? If I ask the audience, I'm sure we can find a lot of gaps. You all have goals to achieve, and you will all be better off if you had more money to achieve these goals. So I think it's very dangerous to look at the landscape through this idea of holding the net or there is a funding gap, because capitalism is made of funding gaps. And the specificity of venture is that it's money that comes with strings. So the money is supposed, as was said, is supposed to come back with a profit eventually, and we're all looking downhill. We're looking for returns, and what makes venture capital active or not active is, at the end of the day, is the returns. It's also a complex industry. It's a transformation industry. We're transforming projects, we're helping entrepreneurs transform their project into companies, corporates, enterprise. And that has to do, of course, with money, with power, with consideration, with growth above all, with governance. So it's something that is not very scalable. It's even large VC funds are tiny compared to hedge fund or funds involved in financial markets. So it's a complex industry. You need some returns, and we're talking about money, and we want to build an industry in Europe. And how are we doing it? We could well, that's complex. We're talking about money and so forth. So we'll try to work with the most sophisticated investors, and these guys will help us build an infrastructure. For example, in the United States, you don't have Silicon Valley if you don't have Wall Street. At one point, even if the culture are completely different, you don't have what made this incredible power, financial power, innovative power that we're seeing with the Google, Apples, and so on, if you don't have the engine of the financial markets behind. We don't have this kind of engine, even if it's true that in some sectors, and biotech is one of them, you can finance companies in Europe through the financial market, but if you take the numbers, it's of course completely different. Again, one figure, Total or Sanofi is about $100 billion market cap. The 5 first tech companies in the US have $3,000 billion in market cap altogether. And the smallest is about like 500. Facebook is 10,000 people with a 500 market cap, 500 billion market cap. So we're not exactly in the same dimension. And actually in Europe, the brightest idea we had is to say, okay, as sophisticated investors, we don't know what they are. Financing of the European economy goes through banks, and banks are not adapted to this entrepreneurial age because we need equity, we need risk-taking differently than there's no collateral and so on, everything that was rightfully stressed before. So we said, well, what we have is government money, and we'll mobilize government money to help thrive an entrepreneurial economy. And so there is the EIF, there is the SME instrument, there are grants at the national level. There are also a lot of different instruments. The UK has itself his tax shelters. France has BPI France and tax shelters. And today, I think if we're honest with ourselves, we probably have a majority of the equity going through the startups ecosystem that is more or less linked to government money. That creates very strong bias. I will name two of them, and that doesn't mean that everything is bad. It's just not to be complacent. The first one is the role of expertise. Since government money doesn't chase only returns, it chases meaning, strategy, and expertise is very important. Expertise is not that easy to handle at this entrepreneurial age. I will take one example, which is blockchain and Bitcoin. This thing didn't really exist 12 months ago, and now in Silicon Valley, nobody's talking software anymore. Everybody's talking blockchain, decentralized operations, and so on. And here in Europe, you have most of the conversation that is, oh, I think it's a bubble. I'm not saying it's not a bubble. A lot of things happen through bubbles. We built the railroads in the 19th century with bubbles. We built the Panama Canal with bubbles. Actually, the internet itself wouldn't be where it is today without the 2000 bubble. So saying it's a bubble is, I'm not saying it's false. It's a good expertise position. I mean, you're saying something with that. But where do you stand in 5 years from now if, for example, there's no software and blockchain is everywhere? How do you think about it? It's very complex to build a company on an open source software like this cryptocurrency and to understand this decentralized ledger system. It's complex. Saying it's a bubble is not an answer. And I think that if we look at success in schemes, funding schemes, and saying, well, for example, if I take this tiny example, where do the European funds stay in financing these new elements, this innovative area, if it is one? That would be interesting to have a feedback on that. Where just do we stand? It's not just a question of amount of money. It's not just aligning quantities. Do we have the people? Do we have the fund? Do we have the network to go outside our comfort zone? This is something new. It's not very comfortable. Is that the internet of value, or is that a scam? But where do we stand in that? I would love to see the European Investment Fund, for example, having a monthly report on some emerging technology and saying where they are, instead of talking very generally about artificial intelligence, for example, which is not really a technology in itself, which is probably not a category, but which is an idea, like Internet of Things. It's an idea. It's not a technology. The second element, and to go at the end with expertise, is that often as a venture capitalist, we have to ask ourselves the question, not is that going to work, but can we afford investing in this company? For example, in Bitcoin, it's not the why, but the why not. Can we really be sure that this will never work? It's a very different question than why is it the future of Internet of Value, for example. So depending on the question that you want to ask yourself, you're building a different infrastructure. The second element with government money is that it's more or less forced to be centralized because you have schemes, you have a collective decision-making process, and this entrepreneurial age is very difficult to understand and needs decentralization. And only free markets provide this sense of decentralization, and government money is not very at ease with decentralization. So we have to ask ourselves if we're not building the wrong model, a model that is more a push model versus a pull model. We push the money into the company instead of having a pull through returns and financial markets, for example, that would nurture the value chain uphill. Who are the clients of the VCs that we're building in Europe? Traditionally, we used to say that the good clients for VCs are the entrepreneurs. VC have to serve entrepreneurs. But if we're asking for government money, aren't we transforming the system? Aren't the clients the LPs? Because the LPs have the idea of the strategy. They want to have a comprehensive set of tools. They want to fill holes in the net. So a fund has a sort of objective that goes beyond serving the entrepreneurs. He's sort of part of an industrial policy, although I'm very provocative here, and I'm sure that nobody wants to assume having an industrial policy through VCs, but there is some hidden objective, and the sign that there is that there is no very clear criteria of investment. And also, aren't we building a system where we have everything goes from the fund to the entrepreneurs? We have strategy, then we have large funds, then we have large checks to entrepreneurs, then we have large company because we have written large checks. Remember that Google was financed with $25 million from Klein Perkins and Sequoia, and there is in our industry no direct relationship between the size of the checks and the size of the final company, especially in a first phase, and this first phase can go pretty far, can be until the hundreds of dollars. What is a growth equity fund? For example, is somebody like, take an example, invested $200 million in Facebook pre-IPO, 18 months before the IPO for 10% share. That means that you're able to value Facebook 18 months before the IPO up to $20 billion. That needs a lot of self-conviction. Your investment thesis has to be very much challenged. No government organization is able to create the chain of responsibility that is going to enable this sort of thing to happen. And actually, it doesn't happen in Europe. So the question is, aren't we building, yes, we're building an infrastructure. There is more and more money. For example, in France, money going to the startups has been multiplied by 5 in the last 5 years, so that's huge. But are we building the right infrastructure? And aren't we building, and I'm very, again, provocative here, aren't we building government agencies instead of VCs? With so much public money, can we really talk about VC? And the last image is, in the 30s, it was very important to have a middle class. With industry comes middle class. And the USSR, which was going to be a great industrial country, had these villages, Potemkin villages, because to show that people were happy and you had a middle class and people were eating well and so on. I think in Europe, we should be very aware of the possibility that we have a complex towards all these big, large companies that we can see in China or the United States, and that we're not going to build our own Potemkin villages where we're playing the game of innovation, we're playing the game of startups and entrepreneurship, but we're doing as it was a game and not a real thing, and we're so maybe building something, but not the right infrastructure. It's just to be open to discussion.
Thank you very much. That's, well, I think you got a lot of good audience here, and indeed, that's really very nice contribution to the discussion here, raising really critical questions. That's why we're here. So the big question of, are we raising the right infrastructure here? It's not just about putting more public money into it, but with the right infrastructure here. Your arguments on moving from a push model more to a pull model, also thinking of what the returns are, not only for the venture capitalists, but also for the innovative investments in the first place too. Also focusing that it's more than money, but also the expertise, the culture for risk-taking within the VC market here. I think these are all very well taken points here that we will definitely be taken up in the discussion here. But before we start the discussion, we still have one more panel member. And this is Rudy Arnoud. He's a Belgian professor. He's a writer, a politician, an economist, and a philosopher. So he's a very multiple heads here. But the reason why he's valuable for our discussion is, first of all, he's a professor in corporate finance. But he was also at the basis of several venture capital actions in Europe. He co-founded IBAN, which is the European Business Angels Network here. So he's one of the fathers of the network. He is, for the moment, he's also a member of the chief economist team of the European Commission at DG Growth, where he very recently launched a new initiative, which is called Ascaler. So it's a new initiative for venture capital funding. He's also a curator at TEDx in Brussels here, so he has many heads, but lots of heads which are also relevant for the topic that we are working on here. So Rudy, now floor is yours.
Thank you, Rinelde. I propose to have my short intervention around some questions I heard from Johan and from Francois, mainly. First, Johan makes a statement from, we lack in Europe growth equity funds. I would say this is exactly what happens now, because we have been working, an organization like yours have been working a lot of scale-up, and we see, if you look now, the start-up problem has been less important if you compare it to the United States than it was before. But we have a serious problem on scale-ups. And I give you some shocking figures. The companies that we finance, and I say we, European Investment Fund, KfW, whoever, all the public institutions, in the first round and the second round financing, out of them, 44 leave Europe in the third phase. So we finance IPR, we give money to companies that leave. This is a shocking figure. And if you look to figures, for instance, in scale-up financing, on average, United States is 21 times bigger. On seed and early stage, it's 8 times. So you see the gap. I know we have some problems with the gap issue, but the gap is in fact bigger in the scale-up phase than it is in the startup phase. And if you look to surveys, you have done a survey 1 year ago, exactly when you had this communication on startup and scale-up, and there 75% of the European companies says, we have a problem to scale up. And 75% said the problem is financing. There was a study done by the consultant Roland Berger. 90% says the biggest obstacle for scaling up is money. And what it is about money, it is, like you say, for the biotech, it's big money. Skype was looking for 122 million. Skype, European company. The average fund in Europe is 65 million. How can you ask a fund of 65 million to put 122 million in a company? The average amount of a scale-up company, I'm speaking about third round or fourth round, I'm speaking about the figure you have seen in the beginning, it's between 18 and 25 million. If an average fund is 65 million, you're not going to put 25 million in one company. So those guys, or they are bought by big companies, or they go transatlantic. And that's why today, if you look to the famous unicorns, you have 150 unicorns in the world, 9 live still in Europe. That's not enough. So there is something, in my view, as a scale-up gap, rather today than as a gap in the beginning. Now, then the question is, what do we do about it? And what is the role of the public? And I think there is an evolution. In the beginning, when the public was dealing with venture capital, what did we do? We, public, we set up public venture capital funds. And then we invented and we invested in all the projects you should not invest in. And you can see the result, the return was negative, and a lot of those funds has been closed down with 0 left on the bank account. Then we said, okay, let's be clever, let's co-invest on project level. But then we still had the negative selection argument. For instance, in Flanders, you had a system where you guaranteed venture capital funds at project level. So you had all the bad projects. Then the third phase, and the phase where we are still in, and I think as Francois is referring quite a lot to that, is, okay, 2008, there's not enough venture capital, so let's put millions, billions of public money into that market. 10 years ago, and I will give a figure, Francois, you should quote next time in your speeches, 10 years ago, 9% of all venture capital in Europe was public. Today, 10 years later, 39% of venture capital is public. So as you say, venture capital becomes public agencies. With, as you say, a problem on bias, a problem of experience, and I would add a problem on governance. Because how can you want that private investors are sitting next to an official guy saying who are we going to invest in, or in the advisory bodies? It doesn't work. And so what you see now, and there was a nice report done last year, is that you have a start of crowding out. It means that the private say, there's too much public, we don't invest anymore. And so in fact, instead of having bigger amounts of money, you have the public coming in and the private going out. And finally, we get there. I don't say that co-investment was a bad thing. We need it. But I think that now we have to do something else. And that's in fact what Renilde was referring to, namely to see what we can do on this Escalar fund. What does Escalar mean? Well, it means another approach. And we spoke a lot about the United States today. So we went there to look what they do since 1958. For those who know the system, it's called SBIC, Small Business Investment Company. So the idea is, in fact, very easy. It is, let's forget about public money. But as you said, Francois, a lot of money in the bank accounts. How can you canalize that money in bank accounts or with patient investors, pension funds, insurance companies? How can you canalize it through the venture capital world? That's the big issue. Well, in fact, what you do, you turn around the philosophy. You say, okay, Francois, your next new fund you're going to create, you're going to raise 50 million, 50 equity. If you do so, and we know the guy has a good track record, we do due diligence, we can say you're entitled, you have 50 million equity, you can raise 100 million on the financial markets, and you get a guarantee from the government. So you can go to the financial markets, you can use our AAA, and you raise that money. Now you could say, isn't that stupid? Well, the default ratio in the United States is 0. Why? One, equity takes the first problem in case of problem. Secondly, it's on portfolio. So if a fund has some bad investments, okay, but have some good investments, so a fund rarely gets bankrupt as a whole. Thirdly, we're in a scale-up phase. So it means already companies still need money, but the most risky phases are gone. So those three factors together makes, in fact, that the default of such a system is extremely low. It can. Who is winning that system? Well, first of all, the equity, because Francois will have relatively cheap money. So he might have an equity kicker. If he runs a fund which makes a return of 10%, well, due to that system, the return on equity might become 15, 20%. The government wins, because the government, we would do it through FC. We have to put the guarantee, but normally we'll never have to pay out parts of the guarantee. So the amount that we really have to book as a probability of loss is very, very low. Patient investors, today interests are very low. They can invest in the risk capital sector between brackets, but it's not risk capital. And so the idea would in fact be that through that system, we try to triple the investment capacity of the big funds who are focusing on scale-up. So now a fund, as I said, in Europe, on average, it's 65. In Europe, in the United States, it's 140. So if you could set up such a scheme, we can make it. Where are we today? We have, in the communication, we mentioned this as something we're going to explore. Tomorrow, we have another stakeholders meeting, if somebody is interested. And in fact, we have now a political green light to work on it, so we try to implement it and to be operational by 2018. But again, this still has to be implemented. So any comments, any suggestions from all of you, they're more than welcome. Thank you.
Thank you. You're taking over my position as the and already handing out the next question. Here. So before we open the floor for discussion to the public, I would like to go one more round around the panel, but very shortly. We've all been pretty optimist here, at least want to be optimist, and I think it's also partly a characteristic of entrepreneurs to be over-optimistic here. But still, nevertheless, I think there were also quite a lot of question marks in many of the interventions here. So I'm actually not so sure we can be that optimistic here. So can we really scale up the European venture capital market here so that we can actually help this scaling up process of startups? It's not only about the money, but also of the expertise here. So what do you think would indeed be the right ways for policy at the EU level here to help scaling up? And the answer could also be there is no way for European policy. Maybe we have too much intervention, and then the best way is to stay out. So I'd like to give the floor to each of you with just a 2-minute state on what you think would, can we be actually over-optimistic, and what you think is the best way forward from a policy perspective here. So which is the most promising avenue for moving on that optimistic road? So, you?
In my point of view, I think European Investment Bank, or European Investment Fund could play a role in that. I think it has been mentioned, they really played a critical role they are the largest shareholder of European venture capital for sure. They really helped also on improving governance. I experienced myself, we raised a fund 1.5 years ago. Due to EIF, as a cornerstone investor, we were able to really use this as a leverage to attract a significant amount of money from family offices and other investors as well. So I think I would assume that they could play a role in there to provide a guarantee or to.
So for you, the EIF,
Yeah,
which is
yeah.
a public institute, is part of the infrastructure here.
Yeah.
Okay. Louis, I guess for you
I
it's the
think
European.
that there's a role both from the European Commission and national governments. I think that, of course, they are today those who legislate, and I think that there's a lot of legislation that needs to happen. I think that, one of the major differences that we have also, it's not just about capitalization. I think that generally access to the European market is extremely more complex than it is in the US. So I think that migrating to the US also makes sense because of the access to market. Today, when we are talking about Belgium, exports to the Netherlands, they are called exports. They are not called, going to another city. And so I think that this is actually something that is well embedded in everybody's mind. So I think this is something that we need to solve. And the Commission, of course, will continue to integrate the single market. I think the European Investment Fund absolutely has a role to play, because I think that there are many ways where it can provide guarantees, but also I think today the work that it has been doing through the funds on funds, through providing equity financing, acting as an investor, albeit a public investor, but act as an investor and delegating then the decision making to private markets. I think this is something that, because it does not know how to navigate the risks of the market, and I accept that completely. And I know that it can impede in many ways, sound decision making, but when the rules are effectively implemented and where the decision-making power is not in their hands, but the capital is provided, then there are opportunities for it to act as a leverage, and I think this is something that needs to be acknowledged. And then there are, of course, many different small implementations that can be done. I think that today, even for investors, it is difficult to be able to, the incentives and the different taxations between all the different member states also make it different for first-time investors who provide in seed investment and who would normally provide in subsequent round. Because of the heterogeneity of hubs today, someone that invests into a company when it is still based in Poland, and then for the sake of raising more capital, that company has to then go to London, Amsterdam, Sweden. Then that investor may not have the same incentives to be able to follow up on those investments. I think that this is also a major change that can happen. We talked at some point about passporting rights and so on. I think this is something that can be implemented. And I think generally speaking, there must also be an incentive. We need to educate also Europeans to seek more actively funds from risk capital. And I think that there has been an interest from American VC firms to invest in Europe. I think that this is eventually going to continue, but eventually this is a trend that will go on. But I think that we need to, of course, keep working in these 4 areas.
Yeah. Okay. So also for you, there is a lot of room for EU policy intervention, but you also mentioned other dimensions like the single market is a very important instrument, and also addressing the fragmentation of the European VC market here. So François, what do you think would be the most...
I would have a twofold approach. The first one is on financial markets. We're talking growth and scale up here. Again, the figures, if you invest 50 million euro in a company for 20% stake, that means that you have a post-money valuation of 250. If you want to make a 5x, because you want to cover some losses, you have management fees and so on, so 5x on good investments is really minimal. That means that you need to sell this company 1 billion euro. You don't have corporate sales to corporates for that. So that means that if you want to have this kind of players, you need to provide them with exit, again, the downhill scenario, and that means financial markets. Financial markets in Europe are not at all what they should be given the size of the economy, and so it's a very deep reflection, and I know that Bruegel is really at the edge of that. How do we mobilize long-term savings to financial market? How we reduce a little bit the size of the financing through the banking system, and we help individuals through professional institutions to invest in good companies that can develop on our geographies. I think that's VC scale-ups is only a tiny part of this huge element, but we shouldn't underestimate it. At the end of the day, if you want to have growth, you need financial market. And just look that a lot of Chinese companies found their growth equity thanks to American funds because of the NASDAQ and the New York Stock Exchange. That's very complex for an entrepreneur because that means usually an American CEO and sales in the United States. That's where the strategic shift that was mentioned is huge. It's not just a cultural or whatever question. It's just that people see value in what they understand. And believe it or not, a French understands French people better than others, and an American person understands American CEO better than French CEOs. The second element would be to introduce a feedback loop in our existing elements. I think that when we're talking about success, for example, a grant system is a huge success because that many thousand companies have benefited from it. I think that shouldn't be the only measurement for success. We should, for example, know what these guys think about it through quantitative data. I mean, it's so easy to have the data today. For example, how can we measure the complexity of a bureaucratic instrument? What is the rate of success? Is a high probability to get the grant a good indicator because that will mobilize people and help them go to that channel because they know that they're not working for nothing? Or is a high probability bad because that means that there is no selection? We're very, after 20, 30 years of evaluation of public policies, my feeling is that in this area of financing, we're at Stone Age. The EIF has only begun to issue very interesting paper, and I encourage everybody to read them, using their internal data. Honestly, they're not easy access. I think they're very good scientifically, but if you're an entrepreneur or you're just, a lay person, it's not very easy to really understand the conclusion. But it's the only effort I see in that direction. Other institutions don't even take the pain to take, here are my data, how I organize them, and I put them in front of the public. So the feedback loop, providing the public with data, being able to have a dialogue about what is a success, what is a failure, what are the good indicators, is something we do every day at board level. In all the company that we're investing in, I think it should be a must-have for any public system.
Yeah. Okay, so can I just follow up a bit on the first point? So that you say, so you really need financial markets here because the amounts that we're talking about, 1 billion that you would need, it's not available by large companies in Europe are not willing to. So why do you think is that an issue? So there are not enough big European companies willing to pay for that? And would that mean that as long as we don't get the financial market system infrastructure correct, that then it's other companies?
I thought I would escape this one because it's a very difficult one. You could think that since in Europe we have very strong banks that like to finance large company, we could have a particular landscape where banks would finance large company who would make large acquisition to transform themselves. When you look at the financial corporate landscape, you say large financial market in Europe are dominated by old companies, but it's also because they transform themselves. Today, this transformation, digital transformation, is creates a lot of friction because it's not like acquiring a Chinese company. It's the people who were at school together that are an M&A department of the large companies and at the startup level. The startup is developing new interfaces or is seeing the market differently. They're disrupting markets. So they're saying to the large company, you could have done it, but you didn't do it. And it's again, something that is business-wise, we're not talking about HR here, is very frictional. For the entrepreneurs, usually when they're both, they don't stay long inside the large companies. So to have these integration profitable for everybody, you need, it's very important that the large company is organized to integrate as quick as possible the acquisition. For example, Cisco is organized for that. Google has done more by itself, more acquisition in 2017 than I think all French companies, for example, large companies from tech companies. So today, there is a lot of communication about how large companies are working with startups, but it's still a little bit of hot air, and they're not really organizing themselves around this objective. We can think it would change. Yeah. We can think it would change, and there is a real logic for Europe to go into that direction. But, is business always logic? Sometimes it's cultural.
But I think it's a very important challenge that Europe also needs to address here, because that part of the ecosystem also needs to be functioning well. And like the example that you had with growth design and BSF, the two sides need to be functioning better. Okay, so, but really, you still have your 2 minutes?
Okay, take 1 minute. First of all, you speak about studies. There have been some interesting studies published 2 weeks ago showing that companies go where the money is, not vice versa. So you need to assure supply, and therefore I think fund-of-fund approach, European Investment Fund, COSME, Escalar, all together, it's important to have the supply of the big money. Secondly, it's not only about supply, it's about demand as well. So there's the whole issue about investment readiness. I think we should work on that as well, that people are open to open their capital. And we still see in Europe that the people try to keep 100% of the shares. It's a second issue. The third issue I think we should work on to have this VC infrastructure. It's a bit the chicken and egg problem. It's, okay, we have some good fund managers, but we need more experienced fund managers who know how to read the balance sheet, who know how to do due diligence, who know how to invest. And finally, I would say, coming back to the example of crop design as well, I think what we have, for instance, what they have in America is a secondary market for venture capital. If you have venture capital and can sell it to another partner, you're stuck with it. And the illiquidity makes that a lot of people are hesitant to invest. So I think we should work on, if you work on those 4 aspects, we might take our time. You must not forget we are 30 years behind the United States. So we need still some time, but we can go faster now.
Yeah, indeed, some patience here, but we still have only 15 minutes left. So now I think it's time for the floor to raise their questions here. Before you do so, can you please identify also who you are, so we're better able to identify where the question is coming from. Okay. Do we have a running mic here? You? Okay.
What?
Thanks for the discussion. Anastasios Papandreou from, I work with the European Commission. One of the things that I spotted from the discussion was the lack of integration in the market. I'd like your comments on how severe this is, because we want to act like a big economy in Europe, but we are not one economy. And for example, also in the patent sector, we still didn't make the unitary patent work. If you want to have a patent in Europe, you have 50,000 euros of cost in order to register in every country. In the US, you access the same amount of market people with only 15% of that cost. So one is that the global economic issue is also something we could discuss. What are we trading off for lacking here? And is this conditional? This is, okay, it's a bit strange, but let me explain. It's a different culture in Europe. We give value to other things. We give value to public transport, we give value to public health care, etc. Is that holding us back from actually giving value to innovation? Is this culture of being more equal, or being more, I don't know how to call it, but you understand what I mean?
Yeah.
2 questions, thank you.
Okay, so perhaps we can collect a bit more questions before. There are no questions. Okay, so then we perhaps try to. So
there are some questions, 1 or 2.
Right.
There's 1, 2, 3.
Right.
3 questions.
Yeah.
Sorry.
It's a bit of a lag.
I don't want to be the call.
Yep.
Hello?
Yeah, it works.
Okay, I don't hear myself. My name is Koert van den Burg. I've been, call me a consultant. I've been working in different countries in Europe. I have more a remark, I don't know if it's a question from the field. basically today I'm asking myself, where should I start a startup? And I've been looking at Estonia, and Skype was mentioned as an example. That was an Estonian company.
Yep.
And they have the flexibility. Any European can be a European Estonian citizen. Extreme flexibility. Everybody can start a company there. Now I am asking, and I have been here in Belgium, I'm Dutch, but I live here in Brussels. I've been on some startup events and so on. It's very easy to get 50, 100,000 euros. I agree. You can start a startup tomorrow, you have money. However, there's the lock-in from the governments. You have to stay in Belgium. You have all this criteria, which for me, or the people I work with, say, okay guys, let's wait a bit. Better maybe to go to France, better to the Netherlands, etc. If you do so, you end up in a kind of corporate, or not even corporate, a small company structure, limited here in Belgium, is an SRL or etc. BVBA. Then you want to attract more investment. The investors have to go cross-border. They shy away. So do I start in Belgium, Netherlands, or wherever? I have examples of companies that went bankrupt because of it, because the Americans didn't want to come in. Now, people say to me, start immediately in New York, in the Delaware. They say, okay guys, I mean, it's just a small company, it's an idea. You don't start in New York with all. But I think this is what we are facing. Now, I know that Europe has some kind of consortium kind of structure that is hardly used. That's a legal entity that companies can create here in Brussels and can be invoicing from that structure. I don't know exactly how that works. I know that it's not a success. That's what I know. But I think if you look, and you have the power of the Commission to make decisions, I think to look at Estonia and to take that kind of structure and maybe to define the startup in a way to say, okay, what is a startup? It's not a bakery at the corner. It means that you have VC capital, which creates certain conditions, but maybe make it more flexible in a European way that all the countries and companies can understand that structure backed by the Commission. And I think then maybe you can, on the demand side, you can get more liquidity in your finance. Because I think really the cross-border problem in Europe is a real problem. Also for I started a company for Germans here. Nobody understood anything of the Belgian law. Yeah, it's very complicated. We are really, as Europeans, we are really not there yet. So that's my 2 cents. I don't know, it's not a question, but...
Yeah, thanks. It also relates back to the previous question on the fragmentation at the EU level here. Does it matter where you start up? Also for... Well, so yes, it does matter. Does it matter for scaling up, but also how cross-border will be VC funding here? Does it matter to get access to European venture capital? Yeah, but before we collect a bit more questions, then we have also have some time to think about the answers. Yeah.
Hello, do I have to stand up? My name is Grace Petrona. I'm from Indonesia, but I live here. I just want to ask a quick question. If someone has a very big project worth around 10 until 11 digits in Belgium, that can really employ a lot of people, do any of you have suggestions which venture capital firm in Belgium and also in Europe that can help? And also, I forgot the professor and what's the name, Mr.
François.
Yeah, mentioned that it's very difficult for projects to get funds a lot. Let's say like 1 billion or even less than that. So I want to ask why, because as far as I know, the European Investment Bank put or allocated funds around 315 billions to help companies or startups to create many employment opportunities in EU. And then also because I have personally contacts with a VC firm from China that is backed by Bank of China. They are specializing in investing for more than 100 millions of US dollar or euros per project, and even billions. Why there are that kind of VC firm in China, and I believe it's not only one, because I know one already. I'm in contact with the gatekeeper in USA, and also they are investing a lot in CBRE for global, but mostly in US for energy sector. Why there are not such kind of VC in Belgium particularly, and also in the EU? Okay, thank you.
Yeah, okay, so let's take the question. Belgium, not Belgium, but at the EU, why don't we have these big venture capital companies here as compared to China? Okay, so our mic is there. The next question. So two more, and then because otherwise I'm...
Yeah, thank you, Bertrand Epre, Schneider Electric. So thank you for the great discussion. I have a question, actually one question about, you mentioned the role that the big business could play in incubating a new startup, right? Which is something that we do with other big companies. And then you, Nicolas Véron, mentioned the fact that, there are some friction.
By the way, it's not Nicolas.
Sorry, François.
My
mistake. Okay, my mistake. But in the end of the conversation, you say it could change, it could evolve to a positive way. And I was just wondering what will be the condition, or what, from your point of view, will be a way to kind of combine those two cultures and make that successful, this kind of model of big business serving as incubator of startups. That's my first question. Second point, which has been not so much discussed, is also a question of people, because what we see in the Silicon Valley is that there are big guys who kind of playing a role to grow those startups. And actually we see in France, which is the country I'm coming from, this kind of culture of people kind of incubating, also a new startup culture. So I'm wondering, what's your view, and whether actually policymaker at European level could play any role in that regard. Thank you.
Yeah, thank you very much for these questions. So one more last one here at the front.
Well, thank you very much. I'm Francesco Mattini. I'm a consultant in energy innovation. The whole team that we've been discussing today is very interesting because venture capital is very important. But the basic is research, is innovation, and where the innovation comes. The last WIPO, or Intellectual Organization of the United Nations, rank Switzerland number 1, Sweden number 2, United Kingdom number 3, Belgium is 24th, and France is 14th. And why this poor ranking? Because research in the first 4 or 5 countries come from university. Universities are pushing for innovation. By the way, I work with universities in UK and in Switzerland, and it's a paradise because the professor pushed the student or post-student to develop technology. Then we validate the technology. We find competition, if it exists, patent, property, intellectual property, and then a spin-off. And the venture capital comes in right away. Imperial College has a big fund that pays for the innovation. The ETH and EPFL in Switzerland has other funds. And by the way, bankers, venture capitalists, go to the university and say, show us, give us something, you see. And all this, it has another element of importance because we need PMEs. They have countries where they have a big industry that produce everything. And of course, at a certain moment, this industry, we see big failures in France in the big nuclear industry because there's no innovation. They're not capable to innovate. In other countries, like Switzerland, like Sweden, United Kingdom, you have plenty of small, medium enterprises that provide the technology to the main industry. And this is very important. So I would like maybe you comment how venture capitalists should stimulate university. I'm talking about university or schools, research centers also. But research centers sometimes are funded by government, and sometimes government does not have any more money to finance the research center. But I think it's very important that people involved in venture capital sit down in a university and say, do you have something? Give us something, and we put the money on. Thank you.
Yep. Okay, so thank you. I think we have a number of interesting questions here, so let me try to summarize a bit. So one big issue of the fragmentation of the European market, not only the product markets, but also the venture capital market. Then why are we missing the really big-sized type of funds here, and particularly public funds, but also private funds? Then the issue of large incumbents, why are they not coming in? The issue of expertise that we might be missing here, and expertise very often coming from successful entrepreneurs here that then enter also into venture capital funding. And then the issue of where the innovation is coming from, the source of universities as sources of ideas here, and how they could actually also early stage fund some of these ideas here that then business could take up here. So each of these are interesting points. I would suggest you pick the ones that you would like to answer here, so you don't have to answer all of them here, so the ones that you think you can address best here. But Johan, for you, I guess the last one definitely is important here, but also this large incumbents, because you have the experience also with crop design on BASF and how did that worked?
Yeah, I think first of all the lack of fragmentation, well the fragmentation, not the lack of fragmentation, the lack of uniformity. I think if I just give the example of, we had several projects I'm aware of that were companies working on GMO crops, so genetically modified crops. As we all know, it's the position of Europe is at least to say it's unclear, unpredictable. And Europe has a tendency, at least taking a decision, a position on potential new breakthrough innovations. And today we have a technology which is, at least in life sciences, has appeared to be major cutting-edge breakthrough. It's called gene editing, genome editing, which has broad applications both in agriculture but also in therapeutics in humans and so forth. Europe has always it's seen as, well, what will be the position of Europe? And it's unpredictable, and at least it's sometimes this type of attitude of lack of transparency scares away investors, of course, because that's an additional risk which is imposed on them. And so that's definitely one area which we see that Europe definitely could improve. Another, coming back to your point, is well, first, I do not totally, I think we should indeed avoid complex corporate structures, but again, it has to do that sometimes companies try to shop and leverage the public systems which are available in different countries. Personally, I don't think this is a good strategy, because it again, you may serve a different purpose. You will establish a very complex corporate structure just to leverage or tap into the public funding system, which may be more favorable in Holland than compared to Belgium, and Belgium compared to France, for example. I think this is not the right thing to do. I think companies, if I look, should be based very close to where the technology is about, where the innovations are being made. I think pool of talent is critical. I fully concur that one of the major bottlenecks we are facing, at least if we want to establish a startup, is the lack of people who have a credible track record, serial entrepreneurs who have done it before with success, because that's what the investors like, this type of people. And I can only say that European investors are even more demanding than US investors, where we see that US investors are more willing to invest in people who have not done it before, but may have the potential to do it. And so that's, I think, where is the best place, where makes most sense, close to a center of excellence where the technology or the innovation has been made, and where we can find the right talents. And that's why, coming back to your point, is I do not fully agree with you there. If you look, I think if you look at the quality of the science in Europe, quality of the science compared to the US, I can say that we are at least or almost at par as with US. So what makes it a difference that we are not so successful in translating this innovation into, in this case, startup activity? And it has to do, I think, with probably an argument which has been mentioned several times. It's a lack of culture of risk-taking. I think we have to recognize that. We have seen that more and more universities, that the Tech Transfer Office was basically dealing with this type of projects in transferring research into innovation and eventually economic activity, are becoming much more professional and much more experienced as well. Although we still have a lag behind the US, but we have also seen that there are several incubator initiatives at universities or research institutes, and that's basically what we do, for example, is to have a very professional team who is basically coordinating projects which may have startup potential from A to Z. And I think this is probably initiatives which, should everything be supported and incentivized? I don't know, but I think it's probably an advice I would like to give to universities and also research institutes such as Max Planck, Institut Curie in France, Karolinska in Sweden, which are very successful institutes. And if you look at them, they all have VC funds associated with them, linked with them. They have a very strong reputation in terms of startup track records. So I think these are probably the examples which we should look at and try to implement.
But again, I think the issue there is also connecting it better to the other parts of the funding escalator here as well. Okay.
Okay, very short. Of course, fragmentation, we all agree this is the challenge for Europe, even in capital markets. And therefore, I think the Capital Market Union initiative is something done by DG FISMA. In my view, that might really be very important to make it, but that's indeed the issue. Now, where should I start my business? My answer will be in Europe, of course. But it's a very interesting question, because we did not some time ago a survey with students between 18 and 21 years old, said, what do you really think that Europe should do? What is the added value? And what came out as the first wish of young people, younger than most of us, was make it easy to set up a company in another country of Europe. I think that's really something we should do. Now, in this communication, which is now 1 year old today, in this communication, we have the proposal of having the European society, not the one which is not a big success, but a classical BVB at European scale, to make it with legal law. So that's something we are working on. And the second point is how to facilitate transnational financing. Because again, if you are Dutch, you come in Belgium, why don't you stay in the Netherlands? And the Belgian bank would say, go to the Netherlands, and it said, but you're in Belgium. You know? It's a kind of a chicken and egg problem. That's something we should work on. And then just my last point is on the big amount of China. I think we all know, and we quoted our amounts we compared with the United States. If you compare with some of the big funds of China, it's indeed the problem. But if you want to find a venture capital fund, you know that Investor Europe is an organization that has all the venture capital funds in Europe who are there, and EIF, I think, is now co-financing and 2/3 of all funds in Europe. So on EIF or Investor Europe, you can find all the funds by the specialty, by how big they are and which are the target projects. So I should say have a look, and then you can do your shopping.
Yeah. Okay, that's way forward. Louis?
I mean, I'm going to say very similar things. I think that generally speaking, the internal market, I mean, the defragmentation, the integration of European markets, both on the financial side, but especially also on the market side, is an issue that we mentioned before. I think this was clearly explained. I wouldn't go, I mean, I think that the question raised earlier on with regard to what we are trading off, and whether more equality also means that perhaps we're going to suck a little bit more at capitalism in general. Perhaps that's something that is very interesting. It will not be possible to answer that today, but I do think that it's an interesting, very interesting question. And I will leave the why we don't have large VC funds funding up to €1 billion per project to those that know this more than I do. But in general, maybe one day this will be a reality. But overall, I mean, I think that the debate is happening. I think Europeans are questioning whether they can eventually compete with their, younger brother or with, the US in general. And I think that this is a healthy debate. I think that, of course, it's been in the I would say aim of the European Commission, especially the Juncker, but also the previous Barroso Commission, for some time. So I think that there are some measures that have been taken both in the securitization markets, both in the financial markets. So there are thoughts that are being pushed forward when it comes to how to ensure that we can sort of have a more coherent internal market. And of course, this goes well beyond the points that we raised today. So it's not just. So it's we'll be very curious to see how this evolves, and hopefully this will, very soon also be solved. But we also have to be patient with ourselves. So I go back to being optimistic, and I do think that it's a very interesting question about whether we are creating government agencies. I think there is indeed a right balance, and perhaps this also gets into the conversation about whether we are expecting some sort of trade-off. But yes, a bit of cautionary optimism still. I think that it's important, and we have seen some positive progress.
Yeah.
Let's hope it will continue.
Okay, so indeed you mentioned there are incremental policy steps that are being taken, but I agree with you, we need to really evaluate whether that's really paying off or not here. So that kind of intelligence we also need to do. François, you have the last word here, and I think you deserve the last word too, because you were the most provocative. So you can end with the last statement.
We need there. I'll just try to answer very quickly on some elements, and I think that's key questions were raised. Fragmentation, the impact is less critical in B2B than in B2C. So obviously in B2C, just the language, whatever the European Commission can do, the language is important. I think we're progressing well into automatic translation, and probably our view on fragmentation, language fragmentation in 5 years from now will be different. And just keep in mind that venture capital in Europe is massively skewed towards B2B, much more B2B startups are financed than B2C. Values, it's absolutely critical. We're good in resilience. US is good at value creation. Again, let's try to make a strength out of our weaknesses. If we are lucid about that, maybe we can build the right infrastructure. Probably tomorrow, the wealth of nation will be measured in terms of appetence for innovation, of agility. There is nothing in the European values, when we look at the core of them, that blocks us from that. The location, a lot of things have been said. Just from the VC point of view, shareholder rights are key. And the first contract, the first element for a VC to invest in a company is the shareholder agreement. People invest in Delaware companies because of the shareholding, the law, the corporate laws, and not the tax status, as some people sometimes think. And believe me, for a German company to invest, for a German VC to invest in a French company is easier today to do it through a Delaware company. So that should be a wake-up call somewhere.
Yeah.
Mega funds outside US and Silicon Valley and Wall Street Silicon Valley, it's political. If you look at Vision Fund from SoftBank and Masayoshi Son, I think you have tens of billions of dollars from Saudi Arabia, Japanese government, and so on. So it's a critical choice. Do we want to have a very large organization outside any control from democratic control? Probably in breach with some competition law, heavily subsidized by political support to sort of rule the industrial development in Europe, or to have a more level playing field. It's a critical question, and it has to be, we cannot have the best of all worlds. We have to choose there. And maybe I will just finish with the question on the large corporations and what are the key success factor for transformation. Again, I think it's a real field of research here. Try to see what experience can nurture the managerial practice. I just throw 3 ideas for the debate. The first term is a change in generation. New managers and younger, not that age solves all the problems, but obviously it helps being open to novelties. The second element is to have a change in organization, give more power to the product people than to M&A and functional level. When a product guy says, I want to buy this company, he's buying for development. He's much more quicker, or she's much more quicker to make the decision. When it goes through M&A, we have all the frictions that we mentioned. And the third one is to encourage, and I don't know how, and again, that's collective reflection, to for this company to have long-term plans that are not just hot air for shareholders, but be able to set a direction, to set a plan, explain how they want to do it, not into details. We're talking strategy here. When you look at Amazon again, this company didn't really make profit for a long time, but they keep going, explaining to shareholders what they wanted to do. And I think that we're in an age of massive transformation. It's important that leaders, and corporate leaders, our leaders, are able to explain where they're going in a simple way so that shareholders can and stakeholders can understand.
Thank you very much. I think we really had a great discussion. I think we can indeed be optimistic. We have a lot of good ideas here. That's not the problem here. I think we can also be optimistic that we can deal with the scaling up issue also on the finance side here, be it with some caution here, because it will take time here, and perhaps we are making too many incremental steps. And what we really need to think of here to address these issues here is really think with way more systems and infrastructure like here. But I do think that this discussion here raised all the good reasons for being optimistic, but also giving us enough food for thought to think about the challenges that are still facing here. So perhaps next year, when we have the second year anniversary, we could have a next year and see how far we have progressed on this year. But let me thank again the panel for being here and contributing and bringing your expertise to this discussion here. It's a too important topic here, so we need all of your expertise here continuously. Thanks a lot, and also thanks for the audience, and see you next year.
Thank you.